Have you ever driven across some massive bridge or flown out of a huge, sprawling airport and just thought, how on earth did this get built? We're not just talking about the concrete and steel. We're talking about the billions, sometimes tens of billions of dollars it takes. Well, today, we're pulling back the curtain on the hidden financial architecture that literally builds our world. I mean, just think about it. This isn't like getting a loan for a house. We're talking about projects on a completely different scale. So for this explainer, let's dream up a project of our own, the Horizon High-Speed Rail. Let's say it's a cool $50 billion train line. So how in the world do you get $50 billion together for one single project? Where does that kind of money even come from? Okay, so Section 1, the multi-billion-dollar idea. At this scale, a single company or even a government can't just write a check. The risks are astronomical, and the timeline can stretch out for decades. It requires a totally different playbook for money, a concept called project finance. And here's the core concept. Now, this is where it gets really clever. The loan to build the railway gets paid back from the project's future earnings, all the money from ticket sales, not from the bank accounts of the companies that are building it. This creates, in effect, a financial bubble around the project. It shields the sponsors from these massive, potentially company-ending risks. So that's the big idea that unlocks the whole thing. But look, a $50 billion project needs a lot more than just a clever concept. An idea doesn't pour concrete. So in Section 2, let's look at who actually shows up to the table with the cash. Who are the players? A lot of the time, it all kicks off with a public-private partnership, or a PPP. You've probably heard that term. It's basically a team-up. The government, which really needs that new railway for the public, joins forces with private companies that have the capital and, frankly, the know-how to actually build it. It's the classic, let's share the costs and the risks so we can get this thing done model. And this division of labor? It's everything. The government's job is to make sure the project serves the public and to create stable rules for the game. The private companies, they bring the cash, the engineering genius, and the day-to-day efficiency to make it all run smoothly. It's all about each side doing what they do best. Okay, so to manage this team-up, the players create this very specific thing called a special purpose vehicle, or SPV for short. The easiest way to think about it is as a brand new, one-job company. Let's call it Horizon Rail, Inc. Its only mission in life is to build and run our railway. This new company, the SBE, is what holds all the contracts, hires all the workers, and, crucially, takes on all the debt. It neatly isolates all that risk we were just talking about. So, the big question, where does our new company, Horizon Rail Inc., get its $50 billion bucks? Well, it comes from two main buckets. You've got a smaller slice, that's the equity. Think of it like a down payment. It's the sponsor's own money, their skin in the game, that proves they're serious. But the real heavy lifting, the vast majority of the money, comes from debt. This is like a giant mortgage taken out on the railway itself, from big banks or by selling bonds to huge investors like pension funds. And this is why it works. You can fund something enormous without having to front all the cash yourself. Now, let's move on to Section 3. Because with $50 billion on the line, you better believe everyone involved is obsessed with one single question. What could possibly go wrong? Seriously, managing risk is the absolute heart and soul of project finance. See, smart projects don't just cross their fingers and hope for the best. They plan for the worst by assigning every single risk you can imagine to someone. For example, if construction takes too long or costs too much, that's on the contractor. What if fewer people ride the train than they predicted? Well, that's market risk, and our little SPV has to deal with it. And what if the government changes the rules of the game halfway through? That political risk, yep, that's on them. So here is the key takeaway, the really elegant part of all this. It's not about making risk disappear. You can't. It's about assigning each specific risk to the partner who is in the best possible position to actually control it. The builder manages building risk. The operator manages operating risk. It just makes sense. Which leads us perfectly into Section 4. So how do you make sure everybody actually follows through on all this? The money, the roles, the risks? You do it with a literal mountain of paperwork. This entire deal is built on a complex web of ironclad, legally binding contracts. First up, you've got the loan agreement. This is the bedrock of the entire deal with the banks and investors. This isn't a handshake, not even close. It spells out, down to the last penny, exactly how and when those billions in loans are going to be paid back. Every payment, every interest charge, all of it is mapped out for decades. Next up, the construction contract.
You know that nightmare scenario you always hear about, where a big project goes way over budget and takes forever to finish? Well, this contract is specifically designed to prevent that. It legally locks the builders into a fixed price and a firm deadline. No excuses. And finally, and for the banks, this one is absolutely everything. There's the offtake agreement. This is the contract that proves the project will actually make money. For our railway, this could be a deal where the government guarantees a certain amount of revenue from ticket sales each year. It's the tangible proof, the piece of paper that says, don't worry, lenders, the cold, hard cash will be there to pay you back. All right, on to our final section, building a greener future. Because this world of infrastructure finance, it's not standing still, not at all. There are huge changes happening with sustainability and technology that are really shaking up the entire game. A perfect example of this is the rise of green bonds. For our Horizon Rail project, we could issue green bonds to specifically pay for the super efficient electric trains or to cover the stations and solar panels. And the thing is, investors are actively lining up to put their money into projects that are good for the planet. And I want to be clear, this is not some small niche idea anymore. The market for green finance has absolutely exploded. We're talking about hundreds of billions of dollars now flowing into sustainable infrastructure all over the world. It's a massive, fundamental shift in how the world invests. And at the very same time, technology is just making this whole process smarter. The days of relying on dusty old spreadsheets are long gone. Lenders are now using AI and powerful data analytics to predict a project's future income with scary accuracy, to model even the most complex risks, and to find efficiencies that can save millions over the life of a project. So there you have it. That's the blueprint. It's this incredible, complex dance between big money, smart risk management, and ironclad contracts that turns these huge, ambitious ideas into physical reality. The tools are getting smarter, the money is getting greener, and it all leads to one big question. With these powerful new capabilities, what kind of world will we choose to build next?